right? So I've explained this. So the next thing to do is to present the future cash flow, right? Is to present the future cash flow. Now, before we can do the presentation of future cash flow, right? Um, we need to, what are we going to use to discount this? What do we use to discount? Are we using cost of equity or the or the weighted average cost of capital? And if it is cost of equity, why do you think it is cost of equity? Why do you think it is cost of equity that we should use? Hello, class. Hello.
I think we're not doing enough data to compute the weighted average cost of capital, but we've
Ah,
already computed the
ah,
cost of equity.
ah. They didn't give us enough information, okay? Okay, now let's check from the question. Let's check from the question. You cannot use cost of equity. Do you know why? Do you know why? Because it is for the firm. Class, you want to you want to calculate the value of ZL. It is ZL. It is not for equity shareholder. It is for the firm, class. Because we were given, you say, okay, yes, there is market, we have current market share price now, so we can use it, right? We have debt here, 11%, we can use it. Class, class. Now, why do we have to use weighted average cost of capital? It is because it is for the firm. It is not for equity holder because this is an acquisition, class. This is an acquisition. It is based on the what? The company, not the what? Equity holder at all, right? Equity holders will not stop acquisition process unless if they are majority. But in most cases, the likes of Tony Elumelu, right? The likes of them, they are the majority. They are more or less like the owners of the business because they have their interest. Their interest is kind of high. Is that not so? So when you want to determine, when you want to present this is acquisition. You cannot use equity because it will be like to equity holder. You have to use weighted average cost of capital because it is to the firm, not to equity holder. Class, am I communicating? Am I communicating,
Yes,
class?
sir.
Yes, sir.
Now,
Yes, sir.
now we must finish this question whether devil just like that bond. Interesting. It's fine. So, and guess what? It is not all tutors will bring this question. They will never bring this question out. Do you know why? Because the question is complex. It is a very complex question. And if you don't have an understanding, a practical understanding of valuation of a business, it will be difficult for the tutor to act, even explain. So you can see the way I'm even explaining it. I'm thinking of another ways that we use to explain it. Now, if you want to use the weighted average cost of capital, We can start. What is our work? Um, for the DCF, we can use the other method. Value of value of equity times cost of equity. Value of equity times cost of equity. I know some of you. I know someone will ask question. Should I mention the person's name? Samson. Cost value of equity plus value of debt. Samson, are you still with us?
Yes, sir.
Plus 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 value of debt times value of debt. If you don't understand this method, use hash total. Mm. Value of debt times cost of debt. You check if it is pre-tax. If you don't understand this formula, use what? Use hash total. Then, if this formula is not correct, let me know. Value of what? Value of debt. Where tax is 33%. Cost of equity. We've calculated cost of equity earlier. What is the cost of equity we calculate? 12, 12.4 or 0.124. Value of equity, that is the market value of equity. So let's go back. Value of debt, that is the market value of debt. KD, which is the cost of debt. If the cost of debt stated that it is pre-tax, you have to say there will be a tax relief. That is when you have 1 minus tax rate. But if it is after tax, you don't need to put it, right? As we've done that under the cost of capital. So now let's quickly check for our variable VE, market value of equity, VD, market value of debt, KD, and cost of debt. Quickly, okay. Now you can see the cost of debt is on loan. It is not on net. It is not. There is no tax relief here. This is the real cost. This is the pre-tax. You can see it now. Now, unless if it is stated that in the question, in additional information, that the debt is what is pre-tax, right? Unless if it is stated that the debt is what is after tax, right? So this is pre-tax, 11%. Please take note. The cost of debt is 11%, 11%, 11%, right? Now, if that would be the case, if that would be the case, you can see the market price. If I want to get the value, class, pay attention. If I want to get the value of equity, right? They've already given you the market price. What you need to do is that multiply the market price, right, times the numbers of shares. We give you the market value of equity. We've done this under the cost of capital. Class, you go to NGS today, you check the market value of Dangote Sugar or Zenith Bank. That is the market price. If you want to get the value of equity, market value, multiply it by the numbers of volume traded. We will get there. That is what's next after Ican. So when you multiply it by the volume, we give you the value of equity, market value of equity, value, right? So since we have the current share price of 370 kobo per share times the numbers of shares, that is 5,000 divided by 10 kobo. I think we have 50,000 shares then. We have 50,000 shares then, right? So, and that is it. Now, that is please take note. Someone should take note of that. 370 kobo times 50,000 shares will give you the market value of equity. Now, what will be the market value of debt? Now, don't forget, let me remind you again. You cannot look for the market value of bank loan. Why? Because bank loan is non-traded debt. You can't find it in NGS under the debt instrument. You cannot find the debt of the market value of debt. Market value. You cannot look for the market value of bank loan because it is not traded in the Nigeria market, right? It is not traded, right? It is determined by the what? It's just the cost. So the real cost, the 35,000 naira given to you in the question is the market value of debt because it is bank loan. But if it is not bank loan, if it is long-term loan, debenture, definitely you would have been given the market price of debenture so that you get the market value of it, right? Now, so please, someone to take note of what is it called? The 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 value of debt 35,000. Then value of equity 370 kobo times 50,000 shares. Okay. Cost of debt is 11%, or 11, right? You can convert it. 1 minus tax rate. What is tax rate? 0.33, right? You can just use 11. Just use 11. Use 11 so that you get. So what do we have here? What is post-tax cost of debt? What is post-tax cost of debt? Quickly, class.
7.37.
7.37. That is the tax relief on it, right? 7.37. That is the tax relief. So which means that as a debt holder, you will not pay 7.37, right? You will not pay what? You will not pay 11%. You will pay what? 7.3 what? 7.37. So of course, that 7.37 is in percentage. So there are two ways. Either you convert your 11% or you convert it later, or this is 0. Please confirm this 0.737, right? 7 point
0.0737.
thank you. So value of debt still remain 35 million. That is 35,000. So the market value 370 kobo, right? That is 0.370 times what is the numbers of shares? 50, right? Class,
Yes, sir.
right? If you don't know how to calculate shares, let me know. If you don't know how to calculate shares, let me know. Your total value of ordinary shares divided by the nominal price will give you the numbers of shares. Class, what is the market value?
18,000.
You say?
18,000.
18,500.
18,500.
Yeah, 18,500.
So therefore, we can insert our formula here. Work. Okay. Okay. Value of equity. The value of equity is 18,500. The cost of equity is 0.124. The value of equity is 18,500. Value of debt is 35,000. Value of equity is 18,500. Value of debt is 35. Okay. So value of debt is 35. Value of cost of debt after tax 0.0737. So class, someone should just give me the figure. I beg. At least we've been doing cost of. Calculate the first one, the left hand side.
Sir,
If it's
if someone is trying to point out the value of equity,
you say
the value of equity is supposed to be 0.7.
the value of equity is zero is what?
And someone is trying to point it out that it's supposed to be 3.7. I don't know.
Okay, share is 370 kobo, right? 370 divided by 100. What do you have? If you convert it to
Yes.
naira, is what?
So that thing
3.7,
should be
right?
3.70 times 50,000 shares.
Okay. Okay, that's fine. Thank you.
So you have 185,000.
Oh, is 185? Okay. Okay, what do you have here?
Zero point 0.12.
Okay. Zero
12%.
0 point, others should confirm 0.12.
12.
Please confirm that it is 0.12. That is
So is it
12%.
the WAC?
Yes.
Yes.
8.6%.
Approximately, it is 12%.
Wait. Okay, if you don't want to approximate, Rachel, what do you have?
11.59.
11.59.
Okay.
0.11.
Okay. But just state it. 0.11,
5.
11.6,
11.6.
abi,
Yes.
11.6 or 11.5.
11.6.
Okay. Or this should be 11% now, right? This should be 11%. Is that not so?
No, approximately.
How many times do you want to approximate?
It's only it's only one time.
You've already approximate to 6. Is that not so? Okay, you still want to approximate again? Okay.
So even if you don't approximate the 6, the 5 approximated to
Okay.
the 1 will give you 12.
Okay. Okay. Unless, that's fine. Okay, so we have, I'm coming. This is 5, 6, right? Then you can now say this is 12%. Is that not so?
5, 9, not 5, 6. 5, 9.
Okay, 5, 9. So others should confirm. Others should confirm. Please, can we move?
Yes. Let's continue.
My people, can we move? Okay, now, class, what do we want to discount? First, this value here is for cash flow for 10 years. This value here is for 10 years. The only 3 years value is the director cash flow. This will be for 3 years, while this will be for 10 years. Don't forget that the question says it is 10-year period. Ideally, this should have joined the 10 years period, but we're told that the consultancy service is just 3 years. The consultancy service is just what? The consultancy service is just 3 years. Is that not so? The consultancy service is just what? 3 years. Now, so this is to tell you that, coming, so this will be for the numbers of years, which is 10 years, right? This will be for 10 years. Why? This will just be for 3 years, right? Now, in this case now, class, don't forget, all these items, all these items are, are in real form. Class, all these items here and what are in real form. Don't forget they say they are in the, I say in real form, sorry. Should we say it's in real form? The current price. Can we say the current price? Okay, that is real. Yeah, that is real. Sorry. So all these things here are their in their current price. That is the real price. Have we forgotten? My people. Hope we still remember the conversion, right? That all these are in real. Thank you. Are in real. That is the current. That is are in cash flow. Are in current price, right? That is the real. Is that also? That is the real cash flow. Now, the weighted average cost of capital, the weighted average cost of capital given to us, the weighted average cost of capital given to us is assumed to be in a money term. The weighted average cost of capital that we calculate is assumed to be in money term. So, which means that we need to convert the weighted average cost of capital, that is a money term, that is money cost of capital, to real cost of capital, so that you can be able to what? Discount this one that has what? 10 years what? 10 years period. Now let me repeat it again. The one quoted given to us, they are all in real form. Is that not so? So what you will use to discount it, it is real cost of capital, right? It is real cost of capital. But because the inflation rate is given to us and the weighted average cost of capital that we calculate, it is not the real weighted average cost of capital. It is a nominal cost of capital. Therefore, we need to convert. Please pay attention, even in capital budget, when they give you question, you have to look at it very well, right? Now, the weighted average cost of capital is in what? Is in money cost of capital. So we need to convert it to what? to real cost of capital. So therefore, what is the conversion? How do we convert this? What is the conversion? I'm coming. Money. How do we convert it? Okay. Conversion of now because of the complexity of this question for the very first time, at the second time, I think second time, I will send the suggested solution. When we are done with this class, I will send it to the platform. Are we together? Because of the complexity of the question, I will send the suggested solution, just that part, just this part. I'll screenshot it. I'll just screenshot and send to the platform. Thank you. So, conversion of WACC to real cost of capital. So how do we convert it? Real cost of capital. Someone should give me the formula. Real cost of capital. RCC. RCC. I need formula. Oh. Ha. Away. Oh yeah, now more they look ourselves.
So
I don't know
can
the
we
formula.
use 1 plus m is equals to 1 plus r is equal to 1 plus r?
That one is money cost of capital. When you want to convert the real cost of
Me,
capital to money
I'm
cost
just
of
saying,
capital.
can you just change your
Okay,
formula
you
to
can.
get the real?
No, I bet who you want to give that? I bet now. Exclusive. Exclusive. So I will now start to make subject of the formula and get to know now. Come on, give me formula. Where is Pemisire? Formula. Olanike, Rachel, Esther, Gifted. 1 plus MCC, 1 plus MCC. Class, 1 plus MCC.
So I don't know if my own is correct. I'm actually having a mix up.
I think it's
1
over
plus I
1
all
minus
over 1 plus m minus
1
1.
plus I.
Okay.
1
So
plus I.
1 plus I. Thank you. So
Minus 1.
minus 1. So RCC equals to 1 plus MCC, which is 12. Minus 1. You know, you need to divide before you minus 1, right? You need to divide before you do what? Before you minus 1. 1 plus, what is the inflation rate?
2.4.
2.4.
Inflation rate 2.4%. So if you convert 2.4% or 0.024, is this correct? 0.024. Is this
Yes,
correct?
sir. Yes, sir.
0.024. So divide, then you minus 1. What is your real cost of capital? You can equally state your assumption, like what Mr. Moses mentioned. but it is not required, and you should know that it will not earn you mark. Mr. Moses, are you still there?
Yes, sir. I'm here, sir.
Oh, you are with us. You are with us. Oh, yeah, shock knuckle, shock knuckle, shock knuckle. Okay, are we still there? What is the answer? Please,
Zero
quickly.
point zero nine four.
0.
0.094.
Okay, 0.094. So that is 9%, right?
Yes, sir.
Okay, that's fine. That's fine. Do you have anyone that, okay, maybe after. Let's, please, if you have question, just jot it down. Make sure you just put it down, put it somewhere, right? Then, in this case now, you cannot discount the one of 10 years. You cannot discount it, right? With, because all this, it is real. It is what? It is real. This, it is what? It is real. So therefore, I have two ways. I can just copy, um, okay, I can say present. I'll start from that real. Present, future cash flow. Net cash flow after tax. 10 years. So what is the net cash flow after tax? So what is the net cash flow after tax? 41,540. 41,540. Right? So the DCF, which is 9%, is for 10 years. So what is the annuity formula? What is the DCF? What is the present value? What is the present value? Hello? Hello? Hello, class? Wait, let's see. My network. Hello? Hello, my
Hi.
people. Okay, are we still together, please? Okay, that's fine. Oh, oh, okay. How are you? Okay, oh. Just the play. Mr. Samson,
Your
the
energy is
powerful.
back. Your energy is back. Oh, let's just go 1 more hour again.
Ah, see this man. I beg now. Cuckoo, cuckoo. Man, no talk. I beg go. I beg. So please, what is the DCF for the 10 years? What is the DCF? Oh, okay. What is the DCF? Quickly. Annuity. Use annuity. Hello, class.
Hello.
Hello. Yeah. Can you see my screen?
Yes.
Yeah, now. Give me figure. Annuity formula for 10 years. don't know what is happening
Six
to my
four
system.
one 6.418. Wait,
Okay.
what are we doing? So
DCF, what is
discount
the present
factor.
value? Yes, for 10 years. This is annuity. You do annuity. This is for 10 years. What do you have? Hello? Hello?
Present value is
6.42.
266,604.
No, give me the DCF first. Give me the DCF. What will be the DCF? Give me the DCF.
6.
Hello, what is the DCF? Are we still together?
6.418.
6.418.
Okay. Okay. I'm coming. 6. Okay. Let me put it this way. Let me arrange it this way. You can arrange it the way you understand, or I beg. 6 point what?
418.
418.
418. So when you multiply this, what will be the present value?
266,604.
266,604.
604.
Okay, good. Right? That is a very good one. So next, we need to pick our redundancy fee. Can you see the redundancy fee? What is the redundancy fee here? 12 million, right? So it is a cost that ZL will need to pay, right? It is a cost that ZL we need to do what? We need to pay. But we don't know the years. We would have discounted it. We're not told that, oh, the redundancy fee. So the redundancy fee we can assume to be at, but hello, class, can you hear me?
Yes, sir.
Hello? Okay, I think my system, I don't know what is that. Okay. So now let's quickly go back, please. You can see that, where is it? Redundancy fee is a one-off. It is not a yearly something. Is that not so? The redundancy is not a yearly something. Sales proceed, it is one-off. It is not a yearly something. Is that not so? So now in this case now, you don't need to get the present value of sales proceed. Why? Because sales proceed is one-off. Redundancy fee, it is only when you want to sell your business before you can say, remember, this is partially acquisition. When we get to merger and acquisition, we will see more of all these things. Sales proceed, we were not told that, oh, this is the numbers of years and this is how we need to treat it. We cannot say they will not receive sales proceed for 10 years. It is not possible. They will not receive sales proceed for 10 years, for 3 years. It is not possible. So therefore, you don't need to discount it. Redundancy, will you keep on paying for 10 years? No, it is one-off. Class, it is what? It is one-off. Therefore, bring the redundancy fee as the present what? As an outflow, then the sales proceed like that. Online are building after tax of what? 8 million. Now, let's move ahead to redundancy fee. Redundancy, right? It's an outflow. What is the figure, please? 12 million, right?
Yes, sir.
That is 12,000. Then sales proceed. So what is the sales proceed? What is the amount for the sales proceed? Sales proceed, please.
8 million.
8 million. 8 million. Don't forget, will be your outflow because Z have to pay this. They have to pay it. Then directors cash flow after tax. You know, it's for 3 years, right? Directors, I like this question. Yes, because you have to think. Directors cash flow after tax, right? So, okay. Okay, what is the director's cash flow after tax? What is the figure?
3 million.
What is the figure?
Two
After tax,
2
after tax,
million
after
and
tax.
2010.
2,000,000,
10,000.
2,000,010.
2010.
010, okay. Now, you know you have to discount it, right? This year, for 3 years. Don't forget, for 3 years. DCF. Now, the question now is, which of these DCF are you using? Will you use for 3 years? Now, which of these are you using? Will you use the 9%? Please, I need your input here. We are not here to cram. We see, we need to like understand these things, right? Are we using the rule of 9%? Then you are now assuming that the 210, it is not in real form. So therefore, you use 9%. Or what do you think? What do you want to use? Or you say, okay, you said the 2 million and 10 is real. So definitely you use 9%. Is that not? Or you think that, oh, this 2 million is just money, is a money, and money will goes with money. What do you think? What do you think, class? What do you think? I need your input here. Ah. Hmm. Where is Rachel?
Yes, sir. Can you please scroll up to the question? I want to read the.
Okay. But I guess you have the question, right? This is it. So this cash flow is what? Is it in real term or in money term?
It is in written, sir.
Okay, money goes with money. Okay, Olanike, okay. Rachel said is in real term. Okay, okay. Olanike, over to you.
Okay, sir.
Quickly.
According to the question, it reads that the amount will not increase with inflation. So I think that means it's in money terms already. It's inflated already. So in my own view, we are going
I
to use
clap
the
for you.
money as
You see,
the
your head is
money
there. You see,
cost of capital.
wait, see, Rachel. Olanike, you have special gifts, right?
No.
Right? I didn't mean you are writing. I didn't mean
Why
you are writing.
don't increase
I didn't mean. I didn't mean you are writing case study. I would have. I would have paid small out of it, right? I would have just tell you that pay this so amount. I will pay for you. That's a very good one, right? Favor to mention it, but you didn't. You should have omit your mic, right? I know on Thursday you know give me gift. Exclusive. So Olanike, don't worry. Just gender inequality. You see, Rachel. Gifted, Pemisire. You see now, they say gender inequality. I don't understand. So, so that is it. It will not increase, right? So that is money. Money goes with money. So we use the 11% to discount it. Olanike, just send I to me on WhatsApp, right? You still have small, just manage small data, right? Right? So it is money, right? Exclusive never win anything for this class. Favor, favor. Then Mr. Moses too. I beg now, Mokuna win something. Then who again? Samson. Samson. We no get
Sir,
time.
just tell us what
Yeah,
to
my
win.
own
Just
no, but
tell
I'm
us,
not
mention
scared.
the gift tonight. You go see the way we go they jump up the do the
We don't
thing.
accept our fate as men. No Allah.
Okay, don't worry. I'll actually change my methodology. When we enter when we enter merger and acquisition, we say it, right? I will ask question from you guys too. So that you can once you
No,
answer
no,
it
ladies first. No, no
immediately.
problem. No problem.
Okay, that's fine. Because the class is kind of dull, right? It's because of the way we started it, right? It's because of the complexity of the question. We need to break it down so that everybody will understand. We will understand what we are doing, right? So we are using the 11%. So for 3 years. So what is the annuity? What is the annuity? Because it is not expected to increase. What is the annuity? What is the annuity?
2.44.
2.444.
2 point.
444.
I can Esther 2.4.
2.444.
2.444. Okay. So what will be the present value? What will be the present value? This is A. This is B.
191.
It's A times B. What do you have?
4912.
4912. Distinguished professional colleagues. So when you add and subtract, what is your present future cash flow? Guess what? This is 10 marks. Present future cash flow. Please, when you finish, you need to write small notes, right? So what do you have? 266,604 minus 12 minus plus 8,000 plus 4,000 this thing. What do you have?
267,516.
Okay. 267,516 like this. 267,516. Okay. This is the present value, right? Okay. Right. This is the present value, right? Exclusive.
Sir, sir, please, I have two questions. Oh.
Okay, don't worry. I'm just
Okay.
I'm rounding up. This is the distinguished professional colleagues. This is the future cash flow, right? This is future what? This is future cash flow. And you can see how it is, right? We have to go back and forth. We have to, and that's it. It is what it is at the end of the period, right? And if you have your question, we'll start from exclusive, right? Please, if you have your question, mute your mic. Exclusive, quickly.
Hello, sir. Can you hear me now?
Yes, I can hear you clearly.
Please, I have two questions. The first one is why did we assume that the work we calculated is in real terms? Why do we have to convert to real terms?
It's a
Sorry.
money
Why did we
term.
assume that it's
It's
in
a
money
money term.
terms?
It's a money term.
Yes. Why did we assume that it's in money terms, and why do we have to convert to real terms? Then the second question is this director's pay. Fine. Why are we using 11%?
Uh-uh. Shebi, the 11%, she will just explain it now that it is not expected. Look at it. Let me start from that part. Because it is stated, look here, it is stated that it will not increase. This amount will not increase with inflation. If this is not increase with inflation, what does that mean? Right? If it does not increase with inflation, what it means is that it is money. You know, money don't increase now. Is that not so? That means it is money. And that is why we use 11%. Because it is not expected to what? To increase. Another way Ican can still come is that, oh, it is expected to increase. So which means that you have to use the real to do what? To discount it. Do you get?
Yeah, yes. But sir, the what was it called now? The okay. I'm trying to the eleven
The
percent
work.
because me the 11% we use, is it from the work?
Yes, it's from the work. Let me show you.
Well, it's 11.6. So okay, but
We
it's fine.
approximate now.
Oh,
Oh, how many
it's,
percent?
it's
Okay, it's
11.6.
12% now. Okay, it's 11.6 or 12.
Yes.
Is it
Yeah, that
12
was
then
even
we
12
decide to
self.
use?
That was even 12.
Let's know. Is it,
It's, it,
wait. Is it, which one are we using? Should we use 12%
if we
or
use
we should use
it's
11, or we use 11.6?
no sir, it's 12 we use in this conversion, so we can use 12, although mine is 11.6. So that's where I had issues.
Okay. Oh, okay. Class. Oh, it's 12. Oh, this is supposed to be 12 now. This is supposed to be 12. You know, we approximate now. Then that is what we use. We use 12 in the conversion. Sorry. So please give me figure. Let's change this figure. So that is a very good one. I've not answered one of your questions, right? I've not answered one of your questions, but wait, just relax, okay? I will answer it. So please give me the figure again. The call will end in 3 minutes away. Which means we have to create another link so that we'll explain all these things in full. I have Olanike, Rachel,
2.40.
Favor. Okay,
40.
2 points, just 2.40 for 3 years.
402.
2.402. Abi,
Yeah.
when you multiply, what do you have? If you multiply, what do you have?
4828.
4828. So when you add, what do you have? What do you have quickly?
267432.
Okay. 267. Okay, let me quickly create another link. Just hold on. Coming. I'll be back shortly. Let's quickly create another link. Final link, right? Uh,
267432.
267
432.
132.
4.
432. 432.
432. Okay. Okay. That's fine. So the 12% is the money, capital given to us. right? Because the director's is cash flow will not increase. So therefore, it is money cash flow. Right? That is it. You didn't answer one of your question though. Exclusive. I'm coming back to that part. I know you asked. Then next, Olanike. Olanike,
Thank you,
before
sir.
Favor.
Yes, sir. Thank you. The only question I have is, can't we grow the 4,000, the cash flow? Can't we grow it with the inflation rate instead of using the real cost of capital? Can't we grow it like the effect of inflation on it?
The first one or the second one?
First one.
The first one. The first one
Yes,
is in real term again. The cash flow is in real term. Is that not
I
so?
know.
The cash flow is in
Yes.
real term. So the annuity, what you need to do is that it is for 10 years, right? It is for 10 years. What would be the this year for 10 years? So you want to use annuity growth rate?
At times when we have effect of inflation on real cost of real cash flows, we do grow with the inflation rate. So at the end of the day,
Okay,
we use
okay.
the
Why can't
same.
we grow? No, no. Do you know why?
Yes.
Do you know why?
Yes.
Okay. Like that one, there is another way. You can use that way. Do you
Okay.
get?
Yes.
See, either there are two ways. Real, either you convert to real, either you either you convert the real to either you convert real to money, right? Then you use the money cost of capital to discount. Either you convert the real cash flow to money cash flow and use the money cost of capital to discount,
That's
or
what
you
I
convert the
do.
real
Can't we
anyone.
review to
I've actually mentioned it.
okay.
Anyone, but it will be safer. It will be safer for you to like just see leave the cash flow, go and convert the final this thing so that you move on. Do you get? Okay. Any other question? Favor.
This consulting services fee, I'm wondering why we did deduct it. Why are we adding it?
No, it's a cash inflow. They will pay ZL directors. They will pay them. They will pay them. Who will pay them if the acquisition succeed? Who will pay them? KKPS. So it will become an inflow to them. Do you get? Favor.
Yes, sir, me too. I understand.
Do you get? Okay.
Yes, sir.
Okay. Gifted.
Yes.
Gifted, your question.
Really, when I rewatch it again and try to solve it on my own, I'll ask questions. For now, I'm still trying to understand it very well.
Interesting. Okay. That's fine. That's fine. It's okay. Uh okay. Exclusive. Now, why we need to convert is because we're given the inflation rate, right? We were given the inflation rate to be 2.4%, right? And when you want to discount, it is the weighted average cost of capital. Is that not so? Because it is the organization, right? On this, in this note, it is assumed that your weighted average cost of capital, Ican will not give you something. They already give you real. They will not give you real. You will not calculate real weighted average cost of capital because inflation rate is given. They want you to do something, right? This question is tested in May 2023, question 1. Question what? Question 1. Because go and check. Because they want to test your knowledge if you truly understand conversion. if the weighted average cost of capital given to you is the real, there is no need for inflation, right? So once you just see that inflation rate, that's something. There's something you must use it for to do something, right? That is why we now say, oh, if that would be the case, what we have in the financials, what we have in the financials should be in money terms, because inflation has not taken into, we've not considered inflation. Let's convert it. Let's get the real. And that is why we're able to convert it from money to what? To real. Do you get that? Hello?
Hello, hello. Yes, sir.
Oh, okay.
Yes, sir. But not like it's clear. But let's just continue, sir.
They play.
Because me, I find it confusing actually. Because if not like you had done it this way, me, I wouldn't have thought in that direction.
But 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 guess what? Even in capital budget, it's always a trap. They will give you general inflation rate, you will ignore it. You will just calculate maybe weighted average cost of capital. After that, you use it to discount. Then you ignore general inflation. That general inflation means that you look at your cash flow. Is it real or money? Before you say you want to convert. Do you get? So the weighted average cost of capital, when it is not
Yeah,
stated, it
yeah.
assumed to be a money cost of capital. Do you get?
Yes. So it's just that what we use for the work is they are all in real time, so we have to.
Okay, that's fine. Rachel,
Yes, sir. Well done, sir. Please, sir, can you hear me?
I'm with you.
Okay, I need a clarity on this real cash flow and money cash flow again. I understand the fact that money cash flow, we use money cost of capital to discount it. Same as real cash flow, we use real cost of capital to discount it. But from the viewpoint of, let me say from my own view, real cash flow is cash flow without the effect of inflation. Why money cash flow is with the effect of inflation. And the information I was given was that the
From your own,
directors,
from your own perspective, right?
yes. So they're like the directors that their fee is without what's it called inflation. So I feel it is real, it is current, it is their nominal
Hmm.
price.
Hmm.
So I don't know if I'm wrong or something.
No,
So I just
no,
need
no, no, no. No, 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 that's not correct.
okay.
Immediately after this, just go to the YouTube as well to watch the video, the class on I know you were in class that day, on real cash flow and money cash flow. I've equally state something there as well. Like, please, you can go there, you can see, you just type real cash flow, it will pop up. Now, when they say something is nominal, so what it means is that inflation is yet to take effect on nominal, right? Is that not so? If they say
Yes,
this
sir.
is nominal, inflation is yet to take effect, why the real you have considered inflation? Do you understand?
So I think it's the
So,
other. Is it not the other way around?
how? Okay, I'm coming. Okay, so is the other way around. Let's check. Let's check now. Let's check. Let's check.
Yeah, nominal cash flow, money cash flow. Then real cash
Well,
flow is like the
let,
actual cash
let's
flow without considering.
let's check. Let's check. I'm
Okay.
coming. Come, let me check my. Okay, go ahead. Someone wants to ask question. Mr. Moses, right? The person should go ahead. Hello? Hello, class. Are we still together? Hello?
Yes, we are.
Okay. I'm coming. System is kind of slow, but it is good to clarify all these things. Let's clarify. Let's check. Body is perfect. Let's check if I'm actually missing it. Where is it? Oh, where is this? I did not. Okay, I'm coming. Let me share my. Okay, there's no need. There's no need to all the material. Okay, 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 class. Okay, I'm coming. I need to. I think I need to share. I need to share. Please, we end this class at exactly 3:30. Please, just 10 minutes more to clarify this. I'm coming. Oh, wait. Okay, that's fine. I think I don't know what happened today. So I have here under the capital budget. I quickly check the material. There are two types of cash flow. There is money and there is real. Money cash flow are the actual amount of cash flow used in transaction. That is, cash flow in nominal terms. They are inflated cash flow. They are what? They are inflated cash flow. That is, the money, they are inflated, right? Then, the real cash flow are the purchasing power equivalent of the actual amount of cash flow, right? These are cash flow without the effect of inflation. Thank you. Now, we're given that all all other price they are on current price. They are on current prices. Is that not so? All other price they are what? They are on current price, right? So which means that what we have, what we have that is being given to us is the current price is in form of real. It is real because it is based on current what? Current price. Is that not so? Based on current price. I think we understood that part. That part. That is why the weighted average cost of capital is assumed to be in a money term. They've actually inflated it. So we have to discount it. We have to convert it to what? To real cost of capital. That is why we have that, right? Now, because the cash flow is in real term, because it's the current what? Current price without what? Inflation, right? Now, the money part of it, where Rachel talk about directors. Sorry, my apologies. I think I mixed it up. The directors, they say it is not expected to be inflated. Is that not so? So if something is not expected to be inflated, oh, you are not saying that since it is not expected to be inflated, it should be in real term. Is that not so?
Exactly, sir.
Okay. That's fine. Okay, now let's go back. Let's check what happened. Right, let's check. Oh, let's check. That's fine. I understand. Let's check. Uh, who is that?
Size Onyinye, I'm the one.
Okay. Go ahead before. Oh, go ahead.
Okay,
Just go ahead.
Sabo, I just had to check online concerning this real.
I can't hear you again.
Sorry, I don't know. I also checked mine online. Like real cost of capital is not yet like it hasn't been adjusted for inflation. Then the money cost has been adjusted for inflation. Is in the nominal
I
value.
just please.
I don't
I
really
can't
know.
hear. Please. Onye, start again. I can't hear what you say. Right? I didn't hear you. I didn't hear you at all. I didn't hear
Okay,
you.
I
Onye,
said, see, I said I saw something. Sorry, I said I saw something online. It says real cash flow means a business cash flow adjusted for inflation, providing a more accurate picture of its financial health by reflecting the true value of money over time. That is, it is adjusted for inflation. That means when it's been adjusted, except if I'm mixing it up, that means inflation, you are taking cognizance of inflation in it for the real cash flow. But money cash flow, that means it doesn't involve inflation, except if I didn't get the statement correctly or the English correctly.
okay. That's fine. Esther. Esther. I think someone was
Yes,
talking
sir.
just now. Go
Yes,
ahead.
sir.
You were saying
So,
something.
like, okay, I actually checked for real cost of capital, not really real cash flow. And they were like, the it has not been taking this what are you calling it? The inflation into consideration. Then the other one then said it has taken into consideration. Now I'm confused.
Okay.
So what are we talking about? Is it cash flow or cost of capital? Is it not cash flow? Is
We are
there a
talking about
difference between cost of capital and cash flow?
no. We are talking about either cost of capital or no cost of capital. We are talking about real cost of capital and money cost of capital. Right? Right? So we are talking about either the real cost of capital or money cost of capital. Is that not so? And real cash flow and money cash flow. That is what we are talking about. Right? Okay, Rachel.
Okay, sir. From Ican Park, it says the real cost of capital is the return that investors would require without inflation. And money cost of capital is the return that the investor would require with inflation. So I think it's the same thing with what you gave us in the material.
Okay. That's fine. That's fine. I think the take home for everyone, right? Because this is 2 minutes. I need to prepare for class, right? I need to prepare for another class. Um, it's just little assignment for everyone. Go and check, go and check, right? I don't want to what is it called? I don't want to. I have my facts. I have my facts already, so I know what I want to explain. But then you need to go and do your research. This particular question, the suggested solution, I will send it to the platform for everyone. Go through it again. Go back and watch the video, right? So if you don't understand, just drop message to the platform. We definitely attend to that. So before we start merger and acquisition, or before the merger and acquisition, I can use voice note to explain something on the platform, right? So that you can have an understanding of why we have to do this, why we have to do that. Firstly, I would just like differentiate between a real cash flow. Either it is a real cash flow or money cash flow, right? And that is it. So, dear professional colleagues, I think I've been able to do justice to this one of the complex questions, right? It is actually complex. When we get to merger and acquisition, we see more questions on the valuation of a business. Guess what? It is just for you to. It is very simple, but it's just for you to go back and do what and look over it, check it again, check it again, check it again. Right? Don't assume that you understand. Don't assume that because you know it in class now, then you forget about it. No, that is not how to learn. You have to go back, go over it, ask yourself question. Why do we have to do this? Why do we have to do that? Do more research, check for this, check for that. You can check because okay, we are good, right? And again, check past questions. Most of the questions that we did, I think undervaluation, like 100% of it, I think it's 100%, 100% of those questions are passed. I know many of you would have checked, right? Many of you would have checked. Most of them are all past questions. So you can also check for more other questions. I think we only have one left in evaluation of the business that we did not do, which is May 2023 question, May 2023 question, May 2023 question 2. I think question 2. Yes, May 2023. You can go there and check it and do that particular question. There is no question. See, all those videos that you watch online, all those social videos, let me tell you something today. Ican has gone beyond all those things, right? Ican is now going like deep, not the usual. Do you see everyone? I know some of you see the bond valuation of last diet. Do you see it? Is it last diet? I think so. Is it last diet or is it last diet? I think there is one bond that has forward rates. I just saw it of recent. I think we
That's
started about 2 days.
May diet.
May diet,
That,
2024.
yes.
May 24. May 24. You can see the way it is complex. And that is how the level it is. It is not the usual government yield plus government yield corporate bond plus private bond. You have your yield to maturity you use to discount. It is not that again. It is not. That is why it is advisable for you to go and check all our videos. Check it. It is ACCA standard, right? It's also ICANN standard as well. Go and check. And anyway you don't understand, just post it to the platform that this is this. And guess what? We will solve portfolio theory. Part of the plans we have now, we'll solve portfolio theory in our revision class, which is paid class, bond valuation in our revision class, adjusted present value in our revision class, capital budget in our revision class, international investment in our revision class, merger and acquisition in our revision class. I will not touch valuation then. It is just for a week, right? So please, we will look at all strictly past questions. We will look at all those complex questions. Complex questions. That is what we want to do. Complex questions, right? So, thank you so much, everyone, for joining, and enjoy the rest of the weekend. Don't forget, exam is close.
Mr. Ibrahim. Hello, can you hear me?
Yes, I can hear you.
Sir.
I can hear you.
Please, okay. After all this back and forth, the solution is correct, right? Like what we did is correct.
You can check, you can
yes.
check me, I don't know. Is it correct? I mean, I don't know. I don't do my. I
No,
don't do.
because of
You can go
no,
and check.
because this one that no, we are not having a dispute between real cost of
No. It's a small thing. That is what I believe that it should be. That is the final present future cash flow. And that is what I believe it should be. Right? Then go and check. If it is not correct, then come
Sir,
back and tell me that this is not correct.
so we are
You
actually
see?
arguing about this abi dispute. I don't really know the term to use.
The directors,
The money cost of capital and the real cost of capital as regards to that
no,
director's fee. Since
yes, that director,
since we are,
exactly.
since we are actually disputing about if it is money cost of capital, because I actually gone back now to check what this money cash flow and the real cash flow is all about. Money cash flow it includes inflation, while the real cash flow does not include inflation. If we are actually dealing with this director's cost that states not taking inflation into cognizance, is it not real cash flow that we're meant to use? I don't know, I'm just asking.
Chidima, Esther,
Change my
right?
estimate.
Esther, yeah, everything join. I've used the one I feel it should go with the question, right? And that is why I'm giving everyone assignments. I said this now. I said that is the as it stands now, right? That is the final answer, right? You can go and check if it is correct or not. May 2024, even May 2023, question 1. You can go and check, right? As far as I'm concerned, that is the final answer. And I said that we will come back before the merger and acquisition class. I may use voice notes to explain that part and send to the platform, right? Then individually, go and do your research and check, is this correct or not, right? Then we'll see what we can do. But that will be before the next class. We should have conclude on why is it real? The main thing is it real? Are we using real to discount, or we are using money to discount? Is that also that is the only thing that is left now,
Yes, sir.
right?
Yes, sir.
So
Thank you,
so
sir.
we'll see what we can. Yeah, you're welcome. You're welcome. So that is it. So the most important, right, thing is your